Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. Last week we had some news from Fed Reserve Chairman Jerome Powell, where he was chipper, upbeat, in a good mood, and alluded to the potential for smaller hike in interest rates in December. Markets, of course, were elated at this news, have since pulled back some, but this begs the question many people are wondering, will the terminal rate remain at 5%? It's sort of data dependent based on CPI anyway. We have a CPI print on the 13th. We have an FOMC meeting on the 14th of December. So we should know much more next week on direction of aggression by the Fed, hawkishness by the Fed into 2023. But other people are also pointing to yield curves, which continue to get more and more inverted. Traditionally, the 2 and the 10 were the bellwethers for recession. That is at multi-year lows. We have the 10 and the 3-month, 10-year, 3-month, also deeply inverted. The 30-year and the 10-year also reaching levels of inversion. So all across the curve, you're seeing markets signaling some issues here, and it'll be interesting whether or not he comments on this next week or he's asked about it. I'm sure a reporter will ask about it. But the question is, how deep can these inversions go before they really do have to take their pedal off the gas as far as hikes are concerned, and potentially even pivot. So we will see what 2023 has to bring and what to expect in 2023 following Powell's remarks next week. There's been a lot of media and discussion around FTX. SBF is still going around talking to anybody who will listen about his side of the story. A lot of the media has missed the mark. This piece has not. Highly recommend reading this from David Z. Morris at CoinDesk. It goes into extreme detail as far as what happened, when it happened, who knew what when, why this is not run-of-the-mill accidents, and appear to be extremely serious. Wall Street Journal has also done a great job highlighting the activities that led to the demise of FTX, of Alameda, of SBF. The good news and the takeaway from all this is, again, the blockchain of Bitcoin, of Ethereum, have no issues, performed extremely well under what was effectively a short-term high load of transactions. We'll take a look at that in a second. Stablecoins working great. Take a look at that as well. It's easy to be in the industry and say this was an isolated incident and not necessarily have someone on the outside take it seriously, because this is what all they see, right? They see the commercials for FTX. They see the FTX arena. They saw pieces for months about how Sam and FTX were going to save the industry. So it's understandable to be confused by comments like, well, this is just one bad apple, when it looks like it's the entire industry, and it certainly isn't. But we're continuing to experience mild contagion from that, mild continuous deleveraging from that. Again, the next big event is probably going to be related to DCG, GBTC, Genesis. Interestingly enough, potentially CoinDesk is involved with that as well, because it is a DCG company. Nevertheless, we go on and we continue to build, as they say. And today it was announced that the Bitcoin app Strike, which operates on the Lightning Network of Bitcoin, has moved into a few countries in Africa. This is the company that's already involved in El Salvador. And they've really been hitting the remittance market hard, because using the Lightning Network, using this app, effectively you can send money anywhere in the world, near instant, near zero. Very few, if any, other services can offer this type of coverage to anyone in the world at any time of day, 24/7, specifically in this case to Nigeria, Kenya, and Ghana, which by the way, for those unaware, are really good with mobile, because they've skipped telephone poles, lines altogether. They've skipped that technology. They have M-Pesa, they have digital currencies that us in the West don't necessarily need or would understand based on mobile minutes. So they're very familiar over there with digital currencies and use them on a daily basis, unlike here in the United States, where we treat it more as an investment than a currency itself. And we can look at the Bitcoin Lightning Network capacity. And because this is similar to a debit and card network, where you can only sort of spend the money you have in the network, we can look at the total Bitcoin sitting on that network, and it continues to remain around 5,000 BTC, 100 BTC. Pulled back slightly from all-time highs, but this is a representation loosely of usage, popularity, transactions. We can't measure transactions directly because it's essentially free-flowing and fully liquid, and it's bi-directional, so you can transact with anyone you want. It just sort of lives on the network, and if you want to effectively cash out, you go to the Bitcoin network and say, I'd like to get out of the Lightning Network, please. You present proof of funds effectively, and then you get back onto the Bitcoin network. But it's good to see that continue to grow globally and to see Bitcoin actually used as a digital currency. We also continue to see build-outs of proof of reserve type systems following FTX centralized exchange debacle. This is good. It is only one side of the equation. We don't know internally if there's some ledger that Binance has or any of these exchanges, right, that say that they're operating fractionally or they have more assets on their ledger than actual in existence. But it's a good start. And, we can go down the list. We can see who has what. We can see all the breakdown, right? This is what the blockchain is all about. We can see cold wallets, hot wallets, over time, what that activities look like. And as users, investors, traders, we're going to continue to push for this or leave exchanges, right? People are voting with their feet, as we'll show in a second, and are leaving in droves as they take coins off exchanges. BTC in the green here, ETH in the pink. These are exchange balances based on the measurable exchanges over time. And again, you can see ETH, the right axis here, down multiple millions over the past month in ETH on exchanges. Bitcoin down around 200,000 on exchanges in BTC terms. So I don't know what necessarily it would take to get users back, but I don't expect this to change necessarily anytime soon. Ledger, the hardware wallet company, announced a new wallet today, and you're going to continue to see new software wallets, new hardware wallets. This idea of self-custody being more and more important, this idea of decentralized exchanges, DeFi, actually having a legitimate use case, unlike many things in crypto, which sort of are empty cathedrals. This whole idea of decentralization becoming more and more important. Don't trust, verify, following FTX. This also means that people aren't necessarily selling on exchanges. They're taking coins off exchanges, which to me is more bullish than bearish. If we were to flip this graph and see BTC and ETH being deposited onto exchanges, that would, to me, represent a loss of faith in the underlying coins themselves rather than exchanges. Looking at some on-chain activity for Bitcoin, we are seeing a slight uptick over time here in active addresses or addresses that have changed in value over the previous day and transaction counts on-chain. This is unsurprising. If there's fear for custody or contagion, you're going to see a move towards decentralization. This makes sense to me. Still range bound over the past year, but not falling off a cliff, not declining. Hash rate's down slightly. This is the hash rate since January 2020. This number in and of itself is a bit fuzzy. It's imperfect. Really, when we get the difficulty snapshots, that's when we know every 2 weeks that's what difficulty is. This is kind of a rough guess as far as what hash rate is. That's why it's very noisy. You can see here, this was the Chinese miner exodus when China banned Bitcoin mining, and then the resurgence in the move to Texas and other states out of China. And now we're sort of experiencing this decline in hash rate as the inefficient miners are extremely unprofitable at these levels based on price, based on transaction fees, based on hash rate. So we're sort of coming to a market equilibrium here where the most efficient players continue to mine uninhibited, and we're sort of culling the pack. That doesn't necessarily mean they leave the industry, they throw out their miners, none of that. They just shut off their miners, right? Now, they may need to pay loans, they may have collateral they need to shore up, but it doesn't mean necessarily that they are gone forever. Or they could even sell their miners to a more efficient miner who, for example, would get better electricity costs. So lots of possibilities here. And it doesn't necessarily mean hash rate will stay down or declining for an extended period of time. But it's definitely something interesting to watch if hash rate continues to rise with prices down here. You're going to see more and more inefficient miners shutting off machines. And one other indicator of miner distress, if we look at miner wallets, and we can see where each Bitcoin, when it is created, sits and lies. We can see who has it. We can see when it moves. And that's how you get measurements like this. We can see Are miners moving coins or holding on to coins? And over the past few months, they've been moving coins. Now, this isn't necessarily all selling, but it usually represents selling. Just as a simplification, if miners aren't holding coins, they're usually selling them. There are ways to curate this data further, but I think it illustrates the point well that miners are definitely under distress here. This previously in January 2021 was a very big Chinese miner sort of selling into strength. Here you have not exactly capitulation, but it is a distress situation where you're selling maybe when you otherwise wouldn't be if you didn't have loans or collateral you needed to shore up. So even despite the selling, prices for Bitcoin holding flat in the meantime. One other interesting metric that I always like to look at is market cap versus realized cap. The realized cap of Bitcoin is a measure of all the coins that have moved in aggregate, and what is that market cap? So if we look at the average price of all the coins that have moved and the market cap, we're actually below the realized price. So another way to think of this, for me, that simplifies it, is sort of looking at realized profit, unrealized profit. At these levels, there are different ways to look at this, but at these levels, I would say that there is very little unrealized profit in the system. We've reset, based on coin movements now, we've reset all of the euphoria, the FOMO, the froth. And we're sitting at levels we typically see or have seen in 2015 and 2019, even during this COVID spike to the low side. We saw those realized profits just evaporate, right? So this tells me we're probably closer to a bottom than a top, certainly based on this metric. And we may spend some time down here, similar to 2015, similar to 2019. Looking at ETH now, ETH has had some decline slightly in transactions and active addresses, certainly is a different picture than Bitcoin. Largely remains in the range of the past year, largely remains near previous all-time highs for these metrics in 2018. The reason this doesn't look like 2018 is because of DeFi. It's because of decentralized finance. There's still plenty to do with your ETH in the DeFi ecosystem, NFTs, GameFi, all sorts of activities, speculative or otherwise, that don't just mean buying it, holding it, selling it when it crashes, right? That's how you get a picture like this, where over the past 2 years, since DeFi really took off, you have sustained on-chain activity for Ethereum. Ethereum also has a fee burn mechanism, and since the merge, going from proof of work to proof of stake, it has dipped into disinflationary or deflationary territory slightly, is now back above in the slight inflation camp. So I think it's safe to say if ETH had maintained its previous issuance in the blue here, in the white here, things would have looked differently in price at 3.5% issuance per year versus essentially zero. Real quick note on Tether, some stablecoin stuff. The Tether price, USDT/USD, the market price, if you will, of Tether in the red here, briefly dipped below 9996 once again. May, June, July was Terra, Luna, UST, Celsius 3AC, Fears, Contagion. This was FTX, Fears, Contagion. Tether kind of gets the brunt of everything. Anytime anything goes wrong, everybody just assumes, oh, Tether's going to blow up this time for sure. This is the one. They're still here. Not going to defend them, but thus far they've been rather anti-fragile in current market conditions. And if we look at adjusted on-chain volume for stablecoins, which just means this is curated, it's trying to remove fake data, it's trying to remove bot-like activity. We did see last month an all-time high in adjusted on-chain volume of stablecoins. So this really matches this idea that in crypto, we do have a need for this type of sector volatility hedge or flight to safety, however people may view it, continues to see sustained activity. And quietly in this data as well is people who are using stablecoins as currencies around the world, along with Bitcoin, along with Ethereum, in Venezuela, in South America, in some places of Africa. Not widely reported, but it is happening, and certainly a small percentage of this total volume, but that also happens on-chain. Moving on to some technicals here, we've got a few charts that really have been looking at for the past few months now. Not much has changed. Really over the past year, we've been below key trend metrics like the 200-day moving average, We're now below the 200-week moving average, the farthest we've ever been historically. And we're also below the cloud here, which is another trend metric. We are out of the extremely aggressive and bearish pitchfork channel. And I think we're just in wait and see mode along with everything else in and around that Powell speech and CPI print next week. What I like about this picture, similar to the bullish picture in 2020 and 2021, when we've been below the cloud, when we've been below all these metrics for so long, the moment we get back above those metrics as a group, you can see we can have fake outs here as we did in March, where we got above the 200-day moving average and puttered out. If as a group we're above these metrics, above the 200-day, above the 200-week, above the cloud, then that gives increasing confidence based on trend that we've seriously turned a corner. ETH, very similar rationale-wise. Below all of the metrics you want it to be above, should you expect continuation to the upside. ETH is a little tighter to these metrics, 1,500 versus 20K for BTC. But almost certainly everyone is looking at these numbers, just as they're looking at the 200-day moving average on the S&P, and we saw a massive reversal over the past day or two at that level. Crypto is no different. So I'd love to see ETH above 1,500 here. And sort of as a side note to think about, there's a potential for a very similar accumulation profile that we saw to Bitcoin in 2015, known as the Wyckoff accumulation. This is the exact fractal pattern that Bitcoin printed, and it doesn't look exactly the same, but it does look similar. And these things often rhyme. This is probably the most textbook example you're ever going to find anywhere as far as a Wyckoff accumulation fractal, but the idea is the same. The next steps here, assuming we are around this stage in this schematic, I think it would tolerate a test of lows. It would tolerate even a spike to new lows. But what you'd be looking for is this sort of W double bottom, continuous buying pressure to the upside until we break this range around 2K. So again, that 1,500 level is important. Making continuous higher highs is important. And it's something to watch for into Q1 2023, certainly. This won't happen overnight. If it does happen, it's going to take some time. But if the Fed slows down, the contagion works itself out of the system on the crypto side of things, ETH could set up to do rather well in 2023. And that also means that it will likely outperform BTC in 2023, partly because of that issuance differential. ETH BTC has been in this current range for around 600 days. Again, it's survived Terra, it survived 3AC, it survived Celsius, it survived FTX now. You couldn't even point to FTX on this chart, likely. And as a general rule of thumb, if prices are knocking on a level for an extended period of time, they want to break through that level, or at least you're more than likely to see an attempt to break that level. So things will get interesting above 0.08. Definitely a chart to watch, though, on trend metrics here. This is exactly what you want to see. You don't want to see anything overbought like we did mid-2021. But again, this thing has just been basically flat for 600 days. So I do like retests of the previous all-time highs, and then at 0.16, it does flip BTC on the market cap. I don't think that will happen at a high percentage chance, but it does have a chance of happening because the staking unlock continues until at least September 2023, if not later. And then in March 2024, we have the Bitcoin block reward halving where Bitcoin's issuance takes a step down. So there is this decent window here for ETH. You could see it test Bitcoin's market cap in 2023. Very long-term setup here, really in the next year and a half, but something many people will be watching very closely. I want to hit on Link really quick because it also has a similar accumulation range, multi-month accumulation range. Not Wyckofian necessarily, but has also stopped declining continuously. It's stopped printing these head and shoulders fractals. It's stopped just in free fall. And they also announced staking today, or rather started early access for staking. And for Link, what that means is a data oracle provider who talks to all of DeFi and gives them the prices that go into how DeFi works. The stakers have a revenue sharing model here. They provide security to the oracles. And so ideally, you get a more secure system that's actually incentivized to secure itself. Now, they already have set aside a decent chunk of the total already issued in the ICO Link tokens that have been non-circulating. Some of those will be distributed to the stakers slowly over time, as well as the fees that they've collected from users for using the Link Oracle service. And thus far, they have around 8.5 million Link out of the what looks to be allotted 22.5 million Link at a 4.75 APY estimated. And again, we can look at all of the Link wallets. This is CoinGecko here. We can look at all the Link wallets ever created. This is a relatively older ICO now in the grand scheme of things. And you can see where all of those staking rewards sit. You can see how they're sort of broken up here into batches of 30 million Link. And so slowly over time, these will get unlocked to stakers. So it's important to see really the DeFi side of things. Is this successful? Does this matter for price? Does it even out at the end of the day? Because we can look at the top 100 DeFi coins by market cap on CoinGecko. We can look at how that looks on a price chart. Similar to ETH, certainly similar to Link. And if we go down the list, most of these top coins are either stablecoins, forks, or wrapped assets in some way. We've got Uniswap and Link. Uniswap is a DEX. Link is the Oracle service. Aave, borrowing and lending. Cake is another DEX. Maker is another stablecoin DAO. Curve, a DEX. Synthetics, lending and borrowing. So there's very few different types of sectors here that could benefit from this style of distribution. But as a whole, it could help DeFi lift out of this funk that it's been in since the end of 2021. And as you can see, that market cap wise, it basically reset itself entirely back to January 2021 levels. That's all I have for this one today. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.